Several indicators this week signaled a softening U.S. consumer and slowing economic growth. The Conference Board's Consumer Confidence Index, CCI, for February plunged to 98.3, down from 105.3 in January, marking the largest monthly drop in nearly 3 years and falling well below expectations, 102.5. The expectations sub-index dropped to 72.9, a level historically associated with recession concerns. Consumer spending data echoed this caution, with personal spending declining by 0.2% in January, marking the first decrease since early 2021. Despite a strong +0.9% rise in incomes, higher living costs and interest rates appear to be weighing on households, a concerning trend given that consumer spending accounts for approximately 70% of the U.S. economy. Housing was another weak spot. Pending home sales fell 4.6% in January, reaching their lowest level on record since 2001, driven by high mortgage rates and seasonal softness. Manufacturing data presented a mixed picture. While durable goods orders surged +3.1% in January, largely due to aircraft purchases, core capital goods orders remained flat, suggesting business investment is stalling outside of volatile transportation sectors. The U.S. labor market, a pillar of economic strength, is showing early signs of strain. Weekly initial jobless claims surged to 242,000, up from around 220,000 the prior week, marking one of the highest readings in months. While weekly data can be volatile, this increase warrants attention as a potential early indicator of labor market cooling. Meanwhile, the government's second estimate for Q4 2024 GDP growth came in at +2.3% annualized, confirming that the economy ended last year with moderate growth. However, forward-looking indicators are flashing warning signals. The Atlanta Fed's GDP Now model slashed its Q1 2025 GDP forecast from +2.3% to an estimated 1.5% contraction, marking a dramatic reversal. If realized, this would be the first quarterly economic decline in several years. The downgrade was driven by weak PMI survey results and a decline in consumer spending. In short, recession risks for 2025 are rising, gaining attention from economists and market watchers alike. This week's economic data triggered the classic bad news is good news reaction in the stock market. The reasoning? Slower growth and a weaker consumer outlook could help cap inflation and push the Fed toward easing. Investors focused on the ECB cooling inflation and Fed policy angle, which helped equities rebound despite the soft growth signals. Treasury yields dropped across the curve. The 2-year yield fell 16 basis points to 4.04%. The 10-year yield declined by 12 basis points to 4.25%. These are the lowest levels in nearly 2 months, reflecting a flight to quality and increasing expectations of Fed rate cuts. Futures markets now price in at least 225 BP's rate cuts by year-end 2025, with the first cut expected in July's FOMC meeting. Just a week ago, the first cut wasn't expected until September. This shift is more about the growth slowdown narrative than just inflation progress. However, the Fed has not explicitly signaled any imminent cuts, preferring to wait for more data before making policy adjustments. In the broader market, the dollar strengthened early in the week on safe haven demand, but gave up gains as yields fell. Meanwhile, commodity markets reflected mixed signals. Oil prices fluctuated and ended slightly lower, 70-barrel WTI, amid growth concerns. Gold prices initially surged above 2,900 OZ, driven by safe haven flows, but later eased to around 2,167 as real yields ticked up. Overall, the macro data painted a picture of an economy losing some momentum, but potentially nearing the end of the inflation battle. As a result, investors are shifting toward a more defensive yet opportunistic stance. This week, several key investment themes, ranging from AI to EVs and renewable energy, shaped market movements. However, the electric vehicles, EV, and automotive sector struggled, mirroring the broader sell-off in growth stocks. One of the biggest stories was Tesla's sharp drop, which not only weighed on consumer discretionary stocks but also dampened sentiment for EV startups and legacy automakers. Concerns about EV demand and pricing persisted, with recent Tesla-led price cuts raising questions about profit margins across the industry. Adding to the uncertainty, policy developments fueled market debate. The Biden administration's proposed stricter emission standards and EV tax credit adjustments, Trump's tariff plans, which could impact auto parts and materials from abroad, raising concerns over supply chain disruptions. Possible Canada-Mexico tariffs and new China-related tariffs could increase automobile production costs, a potential negative for the industry. Traditional automakers like GM and Ford saw flat to lower stock performance, while smaller EV players like Rivian, RIVN, and Lucid, LCID, also drifted lower. Despite near-term headwinds, the long-term shift toward electrification remains intact, driven by consumer interest and government incentives. However, for now, EV stocks are struggling under the same valuation and rate pressures affecting the broader tech sector. Investors will closely watch Tesla's upcoming Investor Day for insights into demand elasticity and new product catalysts. But for now, the EV theme has taken a back seat as markets refocus on fundamentals and macroeconomic factors. The AI investment boom took a pause this week as markets reassessed near-term expectations and adjusted valuations. The week's biggest focus was NVIDIA's earnings report. While the company delivered strong growth, the stock pulled back, signaling that AI hype may have outpaced short-term reality. Investors are now showing they will demand continued exceptional results to sustain higher AI stock prices. Despite this, corporate commitment to AI remains strong. Meta Platforms is considering a massive $200 billion investment in AI infrastructure and research, aiming to strengthen its long-term ambitions in AI-driven content and the metaverse. Meanwhile, Microsoft's decision to cancel some data center leases suggests a more measured approach to balancing cloud capacity and AI-related costs. Overall, the AI theme remains dominant, but this week's developments showed a more nuanced picture. The secular growth story remains intact as AI chip and software demand continues to surge. However, valuations and short-term expectations are being recalibrated, with investors becoming more selective. Notably, AI's influence is spreading beyond tech, as seen in AES highlighting AI data center expansion as a driver of electricity demand in its earnings report. In summary, investors are shifting from chasing every AI-linked stock to focusing on fundamentally strong plays with solid earnings and reasonable valuations. This week, renewable energy and clean tech stocks experienced a mixed performance, reflecting their role as defensive plays amid a broader growth stock downturn. The S&P utilities sector declined around 2%, outperforming tech stocks. AES Corp surged over 10%, beating earnings estimates and benefiting from onshoring trends, domestic solar supply chain development, AI-driven electricity demand growth. Solar stocks had mixed results. Upstream solar manufacturers such as First Solar, FSLR, struggled due to concerns over potential tariffs on Chinese components. Residential solar provider Sunnova, Nova, saw an initial post-earnings pop, but the stock ended the week flat as optimism around tax credits for rooftop solar remains. Wind. Energy stocks had a quiet week, continuing to trade at depressed levels due to supply chain challenges and competition. Nuclear energy stocks gained mid-week, driven by the idea that AI data centers would increase power demand. However, when AI stocks dropped, these names also fell sharply. Meanwhile, alternative fuels saw renewed attention as Congress discussed potential incentives for sustainable aviation fuel, SAF, and hydrogen, though no concrete action has been taken. Key takeaways. Renewable and clean energy stocks remain intertwined with broader market sentiment and sector rotations. Long-term momentum remains strong, supported by policy tailwinds like the Inflation Reduction Act. Short-term stock performance will be earnings-driven, as seen with AES, and will need to navigate the broader growth stock headwinds. This week, the semiconductor sector experienced a roller coaster ride driven by a mix of AI optimism and trade tensions. Early in the week, chip stocks remained quiet, but NVIDIA's post-earnings plunge quickly changed the mood. NVIDIA's sharp EI drop triggered a 5 to 6% decline in the semiconductor index within a single session, reflecting stretched valuations. Many chip stocks had rallied 30 to 50% in recent months due to AI enthusiasm, making a pullback inevitable. Beyond earnings, geopolitical concerns loomed large. A Bloomberg report revealed that the U.S. is considering tighter export restrictions on chip technology to China. Such curbs could limit sales of advanced chips and equipment, impacting revenue for NVIDIA, AMD, and ASML. As a result, the Philadelphia Semiconductor Index, SOX, ended the week down about 4%. Despite this, demand for semiconductors in automotive and industrial sectors remains strong. On Semiconductor reported that EV-related chip orders are still robust, though its stock was swept lower in the downturn. Memory chip stocks, e.g. Micron, also declined, but Micron received an analyst upgrade on expectations that memory prices may be bottoming, leading to a slight bounce. Key takeaways. The semiconductor sector is at a crossroads. Long-term trends, AI, 5G, electrification, remain strong, but short-term volatility is rising due to valuation concerns, inventory corrections, and geopolitical risks. Investors will closely watch upcoming reports, e.g. Broadcom next week, for further clarity on the sector's direction. This week, emerging sectors like fintech, biotech, and space had a lower profile, though selective opportunities remained. Fintech stocks saw mixed performance, largely influenced by rate news. Biotech stocks had some bright spots, with positive drug trial results boosting select names, but no broad sector-wide rally. The space sector remained in a holding pattern as investors awaited a high-profile launch next week. Key takeaways. Thematic investments are still driving opportunities, but companies must now deliver on earnings and future outlooks to justify investor confidence. Simply being part of a trending theme like AI or EVs is no longer enough. Execution and fundamentals are becoming more critical, signaling a maturing market environment. This week, volatility and hedging activity surged, reflecting sharp shifts in market sentiment. The CBOE Volatility Index, VIX, Wall Street's fear gauge, spiked significantly during the worst of the market downturn. By Thursday, the VIX surged above 20 intraday, its highest level in about a month, as demand for protective options soared. This marked a 25% jump in the VIX compared to last week's levels. However, Friday's market rally helped volatility cool off. The VIX fell back to the high teens, closing around 19.1. This round trip in the VIX mirrored the market's rapid sentiment swing, shifting from fearful to cautiously optimistic within days. Options. Market takeaways. Traders selling volatility, writing options for income, faced losses mid-week as the VIX surged unexpectedly. Conversely, those long volatility via VIX futures or calls saw temporary gains. This week served as a reminder that volatility can reprice quickly, reinforcing the importance of risk management in options trading. If you still want to receive U.S. stock information next week, please subscribe and hit the alarm button. Thank you for watching and see you next week.